All right, we are live for Quick Tip Tuesday, each and every Tuesday, 8 p.m. Eastern Time. Today's topic, I want to keep it quick and easy. What not to do when buying a home. So when it comes down to buying a home, there's three main categories you don't want to touch. This is what basically the bank will review to make sure you qualify. Make sure you basically can pay back the loan. It's all about repaying the loan and if you qualify. Credit, income, assets. When it comes to credit, you don't want to run your credit. You don't want to search for new credit lines. You don't want to get a car. You don't want to get any big purchases on your credit. That's number one, because that could impact your debt to income ratio. You can qualify for a certain amount one day. You open a new credit card, a new loan, a new car. That can impact your debt to income ratio, and you can qualify for less, or maybe get disqualified for this loan, or put you in another bracket where your interest rate is impacted. That's one. You don't want to keep running your credit multiple times. Focus on the home purchase. Focus on getting that closed, and then after the fact, of course, do what you have to do. I'm not recommending anything. Go get a new car or get a whole bunch of run your credit, because you still have to pay back that mortgage. So keep that in mind. That's on the credit side. I've had many scenarios where people get a new car, get a higher payment car, open new credit cards. Luckily, with the new credit cards, they didn't charge the card, so their balance is zero. So that's good. So definitely be careful with that on the credit side. Income. The second part of the mortgage process, income. So when it comes to income, you do not want to change jobs. You don't want to change industries. I actually had people change jobs the week before closing. Luckily, that's still closed because they were still within the industry. They were making more money, but there was a lot of hurdles we have to get through to actually get that deal closed. Not many underwriters or processors or people will scramble with the day of closing to still get the closing for the client. You don't want to change from a W-2 income to 1099. This is why you don't. When it comes to 1099, the bank doesn't really know what you make. So when 1099, you pay taxes at the end of the year. Of course, you can write off a lot of expenses. What people do is they have a gross, let's say 100K. They do a 50K deduction of expenses, and then they pay tax on the 50K. When it comes to 1099, the bank will take the 50K of that's what you made. So definitely keep that in mind. So if you're switching from a W-2 one day to a 1099 the next day, you have to wait 2 years of tax return, 2 years of working at that 1099 job to qualify for a mortgage, because the bank cannot calculate what your actual income is. So definitely keep that in mind. What else on the income side? There's a few things I want to discuss on the income side. Don't change industries. Keep working the same hours. Keep focusing on the overtime. Don't work less hours. Just keep that consistent income going. For self-employed people, make sure you have transactions. You have closings for an agent. You have specific things within 30 days of their closing, because the bank is going to make sure you still have income coming in, you still have transactions coming in, and your business is still running as the process is going and close to the closing, and they're going to ask for a profit loss for year to date. So definitely keep that in mind. Number 3, assets. When it comes to assets, I mean, how much cash do you have in the bank? Are you getting a gift? Are you pulling for your 401k? Where's the money coming from? You do not want to use your money for big purchases before buying the house, because you may be short to close. Depending on the type of loan, you can get a gift from a family member or close friend, but just be very careful with that. So with that being said, that pretty much wraps up of what not to do. Focus on that. Remember, credit, income, assets. If you want a smooth transaction, make sure that everything is in line. Don't change anything. And if you're anticipating changing something, speak to your lender, speak to your bank, tell them what's going on. Will that impact your buying power? Would that impact your purchase? Would that delay the process? There's a lot of things you don't want to assume. So definitely have that open communication. You don't want to hold information because the bank will find out. Recently, a recent transaction for myself, a client actually changed jobs a week before. So the bank, day of closing, of course, doing the due diligence to make sure the borrower still works there. The human resource confirmed she did not. So that's what the scrambling was about. With that being said, thank you for joining. If you have any questions or tips or concerns for next week's Quick Tip Tuesday, just shoot me a message.